All right. Good morning, everyone. I hope you're all well. It's been a couple of weeks. So if you're joining us live, welcome. If you're watching this recording, I would say it'll obviously age reasonably well, because there's going to be some topics we have a chat about today that will actually be very relevant not only now but also in the near future, and I would dare say in the far distant future as well. All right, so let's try and keep to our 20 to 30 minutes. So what separates a genuinely hot suburb from a hyped up one? So in my experience, let's talk hyped first. So hyped tends to be around, well, what I've noticed is that it's very driven by one particular industry. And so a very good example would be during the mining boom, all of the mining towns, they were skyrocketing, right? Massively in terms of the property markets. So like houses that were being bought for $50,000 or even less, 20 to $40,000, were getting sold on the market at 200,000, and they were getting heaps of rent too, because workers were actually all sharing the accommodation and sharing the rent, and so the rents were skyrocketing. There was lots of money being paid to workers now, and it was obviously it was a really big boom, and obviously those towns were being really influenced by the boom. Now, I spoke to an enormous amount of people looking at investing in those areas, and they were asking for my advice, and I was kind of gritting my teeth, because the first warning sign is when something's skyrocketing so quickly, especially in a property market. That's kind of, and it's driven not by normal market forces. It's actually driven by one industry. That's your first warning sign in that particular instance, because if something happens to an industry, then it actually collapses. And so what happened is that in the end, in that example, people were buying at $500,000 and then $600,000 because they were watching the scope of the actual prices go up dramatically in a very short period of time. And then the China steel glut hit, and the resources sector collapsed, and then all of those properties dropped to less than 200,000 overnight. So if people had bought in at 600,000, they'd literally made a massive loss. If they'd leveraged themselves, I guarantee the banks would have actually recalled those loans. So it burnt bridges for an enormous amount of people, and they were just caught up in the greed. And so if you find that you're getting all excited about greed because something's growing really fast, that's your first warning sign. And as Warren Buffett always says, be really fearful when others are greedy, and be greedy when others are fearful. So in that particular instance, there wasn't a lot of fear, there was an enormous amount of greed, and that would be, kind of the first warning sign as far as psychology is concerned. I'm going to talk about psychology in a second. All right. So what is it that we want to look for? We want to look for things that are planned on a much more macro scale. So we want to look towards areas that are encouraged by the state government, changing town planning and changing, rezoning areas, right, for residential in particular. And there's employment, and the employment is diversified. When you have a plan like that, and it's obviously not targeting retirees, right? That's not the industry that we're in. We're targeting young working people that are growing in that particular area. Then that's obviously going to be encouraged by state and local government. So therefore you get a manufactured demand. And the manufactured demand works, right? Because the government is actually creating it. They're basically pulling all of those strings. They're influencing the private sector. And so it's a long-term plan. It's a 20, 30, 40-year plan. And in the very, very early days, in that early stage planning, there'll be not only the town planning of the government, but they'll also bring in the private sector. So, they'll bring in Westfield shopping centres, they'll bring in private schools, they'll bring in all different types of industry-led private sector, and they also bring in the very big developers. So in the case of land developers, there's only really five that matter: Stockland, Peat, Slattery Group, Mirvac, Lendlease. All right, so they pretty much control the whole land market in Australia. They're land banked between them. They've got tens of thousands of house blocks that are land banked. So they may be farmland still that's not even rezoned yet, but they know it's going to be rezoned because the government's told them, and the government's told them to go in and start actually, sopping up the actual land itself, because at some point it's going to rezone, or it's been rezoned, they've got their permits and they've launched an estate and they've launched their initial stages in that estate. Right. So, or they've actually a long way, through that particular area. They've already, finished a number of different estates and the stages within them, and they're obviously towards those latter areas. So basically, what then is happening is that you've got the large developers that are actually releasing the supply. So it's not just with land. If I show you an example, and I show you that the same thing actually applies for apartments, right? So this particular region, this happens to be in Melbourne on the Yarra River, that used to be a paper mill, right? That whole site used to be a paper mill, and the state government rezoned it, so it's not a paper mill anymore. So it's a combination. It's mixed zone. So basically, there's retail and all sorts of things, as you can see here in specialty stores and cafes and whatnot. And also residential, and they targeted that area to actually have something like 6,000 or 7,000 residents. Right now, therefore, they've already rezoned, they've already paved the way for the developers. Big developers come in, they say, right, I'm going to build this building. It meets with the master plan that the state government's created, and then they build building one. Right. And so once they've sold building one, they then launch building two. What happens to the price? They grade the price up. Guaranteed 100% the price will go up on the next building, because guaranteed 100% the cost of construction is going to go up. So we know that that's actually going to happen, and that's actually how they then release that supply. As they release that supply and they increase the price, it boosts the valuation of obviously what was initially released, that those particular residents or those particular investors had actually bought in. So essentially, you want to get into areas that have got a long plan, not this flash in the pan, one industry controlling the market. And the same thing kind of applies to, so Gold Coast holiday apartments that, just went nuts when people were moving to the Gold Coast in the droves from COVID. And that's fine. And I'm not saying Gold Coast wasn't a good place to invest, because we had a lot of clients investing in the Gold Coast as well, townhouses in between Brisbane and Gold Coast. But holiday apartments, if there's a stock market crash, then all of those are going to go onto the market the next day, because you don't need a holiday apartment, right? You want to be investing in properties that no matter what happens to the interest rates or to the stock market or anything else, that someone still needs to live there. All right, so essentially, what are the supply and demand signals that you want to be able to read? And one of the things that people don't do that's really simple to do, if you're honed into an area, you can see that in a situation like this, that there's a plan. You've done some research. You know how much the state government want to actually funnel into that area. And you know that there's migration coming in from wherever those places are coming. There's a lot of public transport. There's a lot of infrastructure. There may be even a lot of employment that those young professionals would work in the area. It's got a high walk score when you go to walkscore.com. So then how do you measure the vacancy rate, right? Well, it's very, very simple. You actually see how many are being advertised, how long they're actually on the market for, and you can actually start talking to a lot of the agents that are actually managing those properties and start to actually get an indication from them when you're looking to actually pretending you're wanting to actually rent one of those properties yourself, as to how long it's on the market, what they're getting, the trend of rent, whether that's going up or down, how quickly that they think that it would take to actually rent it, and whether you would have to discount your rent, all those sorts of things. Most people don't do that sort of due diligence. How do you check the demographics? Well, the best thing to do, if you're going to an area where you're investing in a house or a townhouse, go to school pickup, right? They're all there. All the mums are there. The kids are coming out of the school. You get a very clear idea as to sort of what cars are being driven, what the parents are wearing, so all of that. Most people don't do this sort of due diligence before they invest in a property. We do. I mean, that's what we do with our clients. But the reality is that most people invest based on an opportunity and just don't go to this granular level. All right. So What about a slowing or uncertain market? What are the things to do and what not to do? Well, the reality is that, and let's combine a few things here. One is that we're following a cycle, right? So we're following not only the economic cycle, but we're following the property cycle. And if we're following a cycle, that means that the cycle completes itself and it starts again, or it completes itself and it starts again. We don't want to be caught in a cycle where the market has actually slowed down and I can't afford to hang on to my property anymore, right? Or the property market or the interest rates have gone up and I can't afford to hold on to my property anymore, right? Because the cost of holding on to it is too high. So that's not macro thinking. What you want, a strategic approach that not only takes you through to retirement, but allows you to zoom out and say, right, at all stages of the economic process, how is this property going to perform? Have I done my numbers? And so when the interest rates obviously go up, the property market in terms of growth flattens out. That's what happens, right? And so when interest rates go up, there's more people wanting to rent, and then there's a high pressure on rent. So if you're doing research on an area that's highly gentrifying, people are moving there, they're wanting to live there, and there's employment in that area, and they're enrolling kids into the school, then they may be renting for a period of time while the interest rates are higher, waiting for those interest rates to come down, right? Or waiting to get through an uncertain period. And so therefore you'll be capitalizing on those rental markets. Then there's all sorts of other pressures that have actually hit the rental market. I mean, we had a situation where they opened up the international borders and state borders after COVID, flood of migration, loads of demand on rentals. Then there was a slowdown also in supply because of COVID. And we obviously had a disaster because interest rates were increasing as well, because interest rates were increasing because inflation was high, because the government printed $300 billion over the course of 5 years. Print $300 billion, and then yes, you're going to have very high inflation. Blamed us, increased interest rates, more people even wanting to rent again. So therefore, you've got a rental crisis. Now, just as things are starting to equalise, the government go and actually change the negative gearing tax laws at the last budget. And we know from 1985 to 1987, when the last Labor government did that, that rent spiked. Well, that's exactly what's happening now. So therefore, it's not the rents that are spiking in the areas that are regional, that were established properties that were driven by a lot of buyers agents, for example. I mean, I've come across clients recently where they've gone from a buyer's agent to me, right? They've preferred to deal with me than a buyer's agent. And this is what I'm finding as a trend now, is that they were being shown properties in Townsville, regional, and getting 8% rental yields. Right. And I said, well, what would you get? They live in Sydney. I said, what would you give in Sydney where you live? And it's 3%. I said, so why is it such a big difference? Like, have you actually stopped to think why the rental yield is so high? And the reality is that it's the actual rental inflation is still the same, right? No matter whether it's Townsville or Sydney or Melbourne. I mean, obviously it's going to be slightly higher in Sydney, but you still get rental inflation. So why is the rental yield so high? And that's because the properties that have been shown to them in Townsville aren't growing, right? So they're not growing as well. And Sydney is the opposite. The properties tend to grow really hard, and therefore that lowers the yields too much, so that when interest rates go up, in my opinion, those markets are unstable because they really were overvalued. They were overpriced. And the reason I know they're overpriced is because the affordability of the rental market is only 2 to 3%, not 4% to 5%, which is the properties that we would look for. So you need to actually do your numbers for all stages of the cycle. And that's why, I'm really finding a strong trend now that people are coming to me and saying, look, I was talking to a buyer's agent. We're in Townsville. Lucky I didn't buy there, because they're the markets that are obviously really suffering as a result of government policy. So you really want to make sure that you're already prepared and got a plan long term for all stages of the cycle. So if interest rates go up, you don't skip a heartbeat, right? You actually, you don't lose any sleep at night because you've already anticipated it. And you know that if you wait long enough, when you go through that stage of the cycle and it's flat in terms of growth, that you're then going to be in pole position when you go through that next stage of growth. So that's the game. It's long term. It's not trying to play markets where you're getting out low and getting out high. And so when you look at when the government introduced policies like negative gearing and whatnot, and when they start playing around with fiscal policy and introducing first home buyer grants, etc., you can see that there's always a growth ultimately in the year or two that follows. Same when you actually have a stock market crash, right? Or something that's very akin to that. So let's look at Black Monday in the 80s. So Black Monday, everyone was freaking out, lots and lots of fear. The reason why stock market crashes is because people are pulling money out, right? So if you're pulling money out, obviously it's going to go down, right? And if people are pulling heaps of money out overnight, then it's going to go down a lot overnight. It's going to crash. Now that doesn't happen in the property market because 62% of it is propped up by the banks. So if the market's coming out, so the money's coming out, where's it going to go? And so in my experience, it goes into cash. So it goes into cash investments. It goes into banks and managed funds and pooled funds, etc. It goes into things like precious metals and alternatives. And then it also goes into real estate, commercial and residential. And so lo and suburbs, look at what happens in the years that after the Black Monday in terms of residential median price. Now, when I started investing in the 90s, there was very much, so I was 96 and the market was really, really strong. The rental market was strong. The very first property I invested in was an apartment getting a 6.3% yield. All right. And so, and if I put furniture in it back then, there happened to be a market for doing that, not so much now, I could get a 7.8% yield, right? But the area was heavily gentrifying. When my accountant saw where I was investing, he had a heart attack. He's like, oh my God, what do you want to invest there for? It's full of street workers and drugs, and there's lots of homeless, and like, what a disaster. And I said, no, Max, it's going to gentrify, and these are the reasons why, because this is what I've been taught by my mentor. And lo and behold, that's exactly what happened. So that's why the yield was high, because the area was gentrifying, and it wasn't just gentrifying because it was a regional area. It was an inner city suburb in Melbourne. It was St Kilda on the water, and I actually had a water-facing 2-bedroom, 2-bathroom, double car space apartment. So then the dot-com bubble burst, right? And I started freaking out because I was very laser focused on the media. And what I've discovered is this: if you have not a lot of knowledge and you laser focus where the media take you, then you're going to actually freeze in fear. And whether that's in investment, whether that's in a pandemic, doesn't matter what it is. If you focus on what the media get you to focus on and it's micro instead of actually being macro, then you're not going to be able to make very, very sound decisions. And so you can see there that at that .com section that people were freaking out, and some people dumped property, and I was going to do that. If it wasn't for my mentor to say, hey, Jace, chill out. Where's all this fear coming from? Turn off the television set, right? You're destroying your potential of what you can, what wealth you can make. He said, I've seen this happen before. You don't want to be a part of that. And I'm glad that I listened to him, because then what happened after that .com bubble bursting, then the market started obviously really going up, because people were pulling the money out of the stock market with the .com bubble bursting, and then they started dumping it into real estate, right? So it's a cycle. This is what happens. And so from a psychological point of view, as I've said, you just don't want to get caught in fear, right? And fear traps. And so it's really, really obvious now that a lot of people are actually have been, really, really agitated by fear with respect to what the government did. And even though, myself and my colleagues at Property Investors, we've been really, really busy, because everyone that we'd spoken to that were umming and ahhing, or we were going to set up a self-managed super fund maybe in a year or two, all of those plans have been pulled forward, and we've obviously managed to get successfully all of our clients successfully invested before the 10th of August, which is obviously just under a week away. But if it wasn't for that pre-education that we had done with all of those people, they wouldn't have obviously done that. And that's what's happened, is the government has put the fear of God into people through the media. And so a lot of people have actually abandoned that. And then that creates opportunity. So in a market where there's a lot of fear, because remember, right, be fearful when others are greedy, right, and be greedy when others are fearful. Now is the time to be greedy because there's a lot of fear. Now's the time you want to be swimming upstream to everyone coming downstream, with respect to investing in residential property. So what are the benefits of now? Well, I can tell you that number one is that we can actually set up investment strategies where right now you're actually getting in and you know you're getting in at the flat spot. And so therefore the cash flows are really strong because more people are renting. So cash flows are really strong. It's a rental crisis. You're going to get much higher rental revenue. And then that's actually helping paying your own mortgage debt, which is the single biggest source of financial risk in the average household. Right. So that's the first thing. The second thing is that it is incredible for getting stock opportunities, investment residential property stock that we just couldn't get before. Now we can get it, and we can get it with incentives. We can get it with sweeteners from the builders and the developers. And I love this time because, everyone is that now, by the way, no one discounts price because then that screws everything up. No one discounts price. They'll give incentive, right? So they might actually give an incentive as they might give so for example, they might give a stamp duty incentive. They might give a cost incentive of your property because they can write that off on their P&L, but they don't want to write down their balance sheet. It's their balance sheet that helps them to actually get the money from the bank. And it's their balance sheet if they've got investors that they're looking at because they don't want to see a shrinking balance sheet. They want to see that you're still getting the price point actually in the market. And who I'm referring to, obviously, is the builder developer. So as a result, there's great deals and there's just stock that we couldn't get before, right? So we're now we've broadened our stock, the actual catchment areas that we can get stock. We can now get stock in blue chip areas that we weren't getting before because the cash flow works for one of our typical clients. Now, it may not suit all clients, but the point is we weren't able to get those opportunities before. And that's obviously why when you keep your cool and you hold your game, you educate yourself and you keep a macro approach, then that's when you've got opportunities. And so the Great Depression, I mean, people talk about the Great Depression in the early 1900s and about, how hard it was for people and people living on food stamps, all the rest of it. And I get it, right? I mean, I think I've told you guys before that when my grandmother died, it was literally a treasure hunt at her house. We found about $20,000 in cash stashed all around the house, in walls, under beds. We dug up in the ground. Like we literally had a treasure map. It was incredible. And that was because she lived during the Great Depression and she had those very strong memories during the Great Depression. So she didn't have a complete 100% trust of the banks. So who won? What was the opportunity? Well, Rockefeller, who'd made all his money in oil, bought up half of New York. He bought up a whole lot of newspapers as well, and he bought up universities and everything else and started Big Pharma. But the point is that Rockefeller, he had heaps of cash and there was just opportunities everywhere. And if you look at the activity from people like Warren Buffett, you'll see the similar things. Warren Buffett cashes in at certain stages and then goes out and just buys everything when everyone's freaking out and jumping ship. That's when he gets on board, right? And when everyone's really, really greedy, that's when he starts to cash in. So with property investing, we don't have to cash in. We don't want to cash in because the government's going to obviously tax us with our capital gains. There's heaps and heaps of other ways to transition to retirement later with that growth, or even if you want to actually live on that capital growth in the meantime, you can. And we've spoken about that before, and we can talk about it a little bit more in the future. But the point is that now are the best times to obviously be getting opportunities that just we weren't able to get before. And so when they say, is there opportunities we couldn't get as little as 2, 3, 4 months ago? Yes, 100%. I literally just did a contract this morning with a client that there is no way I would have been able to show that to them 3 or 4 months ago, right? If it wasn't for the budget, all right? So thank God for the budget for those investors and for my other clients. Let the fear live with everyone else. That's not the game that we're playing. We're going macro. We're educated. We understand how the cycles work. and we don't get caught up in the fear matrix. All right, guys, hope that resonates with a lot of you. We'll see you in a couple of weeks. And always reach out to one of the agents at Property Investors if you have a client that sort of maybe thinking, could be. There's plenty of opportunities that we have, obviously, for all different types of investors. So don't think that you can leave anyone out. All right, have a great couple of weeks, and we'll see you then. Cheers.